Credit, the new voice in the room. The rise of credit investing over the last few years have been a prominent trend in the Indian financial landscape. As investors seek alternative avenues for generating returns in a low interest rate environment. Credit investing involves allocating capital to debt instruments such as corporate bonds, loans, and structured credit products, with an emphasis on earning interest, income, and potential capital appreciation. This strategy has gained traction due to its ability to provide yield in a diversified portfolio, offering a potential hedge against market volatility. Institutional investors, including pension funds and insurance companies, has increasingly turned to credit investments to enhance portfolio performance and manage risk. Moreover, the growth of private credit markets, where non-bank lenders extend loans to businesses, has fueled the expansion of credit investing, providing a broader range of opportunities for investors seeking yield in various credit risk portfolios. For the panel discussion, I would like to call on stage Divaspati Singh, partner Khaitan & Co, senior chair. Let's give it a huge round of applause for all the panelists. Neeraj Ojha, head fixed income and offshore products, Spark PWM. Sandeep Adukia, managing director, BPEA Credit. Ladies and gentlemen, I hope you all had a very satiating lunch. So where is the energy? I want you all to applaud. Come on, everybody. Thank you. Next, I would like to call on stage Vineet Sukumar, founder and managing director, Vivriti Group.
Hi, thank you so much for that. And a very warm welcome to all my panelists here. And a good afternoon to all the attendees who are present in the room. I think, Aditya, you've given me the toughest job to host a panel on credit right after lunch. So, for our panelists, we not only have to keep them informed, but also entertained so that, people don't go off to sleep. If somebody wants to, get a refill on their coffee cups, this is the right time as we begin. Before we delve into our discussions, I'd like to introduce all my co-panelists who are extremely accomplished and eminent professionals in their respective fields. I'll start off with Sandeep. Sandeep is one of the co-founders of Bearings Private Equity Credit in India and is the senior managing director. He's one of the most senior professionals with experience spanning over 3 decades on credit and related sectors. Bearings, of course, started off almost a decade and a half back in India, focused on the Indian markets, and now they've expanded their footprint across Asia. Sandeep oversees the group's business development, fundraising, and manages investee company relationships. Welcome, Sandeep. Next, I'd like to introduce Vineet Sukumar. He's one of the co-founders of Vivriti Capital and the CEO and head of Vivriti Asset Management. Vivriti, of course, as we all know, is one of the largest debt platforms in the country. They run a very successful debt marketplace called Cred Avenue. They have a very large NBFC book, as well as a very successful asset management business on credit as an asset class. They've set up several funds in India and overseas focused on the Indian credit space. Vineet, of course, himself has over 2 decades of experience in financial services and performing credit. And last but not the least, I welcome my third co-panelist, Neeraj. Neeraj, of course, heads the fixed income and offshore products at Spark Capital. Spark is a financial services conglomerate focused on asset management, wealth management, and investment banking. Neeraj has over a decade and a half years of experience across several large institutions in India. A very warm welcome to all of you. Before we get into the discussion and before I start with some of the questions to you, I would like to sort of throw some general facts around credit. I think In the last several years, there's of course been a massive boom on credit as an asset class. Credit has been much talked about, not just domestically, but also internationally. And at least in the domestic market, we've seen credit growth across the entire spectrum. And it's not just performing credit. We've seen growth in structured credit, distressed credit, venture debt, and across the entire segment. According to some industry estimates, credit deployments could increase almost to $80 to $90 billion in the next 5 years. And on the distress side, these deployments could go up to $25 billion in the next 4 to 5 years. This is, of course, a massive, massive opportunity. In the years post-COVID, just in India, when we look at very specific numbers, almost 35 to 40 funds have been set up focused on credit only in India as AIFs. Now, this shows very promising numbers. So, Sandeep and Vineet, let me start off with you both. What, according to you, has led to this growth of credit in the last few years?
Hello. Yeah, thanks, and good afternoon, everyone. So that's true, Devas. I think I think the biggest reason I feel is when I'm talking more from what we do, which is more structured credit, is what I feel is non-dilutable equity. I think clearly we can see these days, and we've done more than almost nearly 75, 80 trades across last couple of years. We see that there are promoters who have really now realized or actually feel that equity is one of the most expensive form of raising capital. And that's where they actually feel that growth, if you can get growth capital, which is non-dilutable in nature and which basically can give you a flexible amount of decent amount of capital, which can help you to grow and take you to the next level, I think I clearly feel is one of the big reasons why you see credit growing in the markets.
From our perspective, I think the biggest by far has been the formalization of the Indian corporate space, where either on account of data, governance, capitalization coming in, or the kind of business promise that the various sectors have to see, we see a far higher number of companies falling into our addressable space. So, for example, the entire debt space has been dominated historically by mutual funds because at the end of the day, they deal with listed companies which throw out data. And the problem has always been, if we go down the rating scale, how do we really assess whether financials are genuine and companies can be worked with? I think that landscape is radically changing. And I think that for us, dealing in performing credit is the single biggest factor why we have been able to grow the way we have.
Interesting. And just one point which Sandeep mentioned in terms of private equity and everything. So that segues to the next question for Neeraj at least. Neeraj, I think with the last couple of years, I think M&A activity last year, we saw a decline. Even private equity activity in India saw a decline. Valuations have also corrected across various asset classes. And so what do you think that there was an opportunity for credit as an asset class? Did you see any kind of increase in activity amongst your clients, amongst your advisory mandates?
Yes, so I think while Sandeep and Vineet covered the entire spectrum of performing credit, I think or private credit for the entire space, I think performing private credit can be actually broken up into parts. Venture debt is an important portion which actually contributes a lot in the overall space. We saw a lot of activity there. Of course, growth capital is the key for such companies which are at a venture stage. So there, because of the valuation, I would say expectation mismatch, as well as some amount of push from the founders to delay the further rounds. I think venture debt was an important asset class that actually cropped up as an important both from a supply as well as demand drive. And that I think will continue unless and until there is some amount of sanity that comes on this space. because that can be a good segue and I would say good runway for these kind of early stage corporate venture debt kind of companies, which can actually take them to the next level until the valuations kind of cool off at that point in time. Apart from that, of course, performing credit also has seen a lot of, I would say, upside from this activity, because growth capital is the need there as well. Flexible capital is the need there as well. And at that point in time, I think with the space that has been created by the NBFCs and the banks, I think AIFs have taken a good lion share there. I think there is miles to go. But still, I would say this is an important asset class, both from an investor standpoint also, because I also represent the private wealth business, wherein there is also an increased interest from investors to look at this asset class, not only from a satellite allocation, but an important allocation in their debt portfolio, because otherwise it becomes difficult to kind of get these kind of investment opportunities directly. So that is my take.
Just to add, I think there was, to pertaining to your question, which is saying that was the sort of shortage of P or M&A activities, did they lead to sort of, more of credit? But I think that could be just one of the reasons. I think there were multiple other reasons. I think what some of that activities actually created was it gave the promoters a chance, saying that now, okay, fine, I have been with a private equity for an X number of years. It gives me, today there is an option available to me to sort of get this kind of a, sort of capital available to me, which can allow me to perhaps buy it back from the equity. So there are a lot of, and we are much more of a specialized on the mid-market sort of, and which we'll sort of talk about later. But in that sense, we clearly see that there are a lot of promoters who don't want to either not go public, or they don't, and they feel that this is an opportunity to perhaps buy back your equity through private credit platforms. So I think that's one opportunity we see for sure. But more or less, I think, we've almost added we've seen deal flows almost 40% increase over previous year to this year, that is from 22 to 23. And we clearly feel that it was a complete mix of all kinds of financing. Perhaps this could be just one of the reasons.
No, that's interesting, Sandeep. And my next question, of course, both to Vineet and you. So I'm a lawyer, I'm trained to be a skeptic. Just when we look at pure empirical numbers, India on the credit side is one of the least penetrated economies. Credit in India is only 55% of the GDP, while the global average is 148%. Even amongst the Asian peers, China stands at 180 plus, Vietnam is 150 close, South Korea is somewhere around 160% plus of their GDP, while India is just a mere 55%. Are you seeing this as an opportunity, or is there an issue, which is why credit as an asset class has not been growing? So just would like to hear your thoughts. And like Neeraj also mentioned that, with banks, RBI tightening the noose around banks in terms of deployment across the spectrum, NBFCs, of course, going through their own liquidity crisis in India. Now, is that an opportunity, or is there some issue because of which credit penetration in India has not been as much?
I think multiple factors go side by side. Let's take a comparison from India to US, not in terms of headline numbers, but more in terms of, say, deals that we see. The most frequent use of mid-market direct lending in the US is where a bank has already allowed a company to go to 3 times net EBITDA, and a private credit fund or a mid-market direct lender takes the company from 3 to 5. Okay? Why is it acceptable? Because cash flows are steady, there is a very clear insolvency and bankruptcy code regime in place, legal structures are sound, and therefore higher leverage is tolerated. Right? In India, we are a direct lender, so we are a direct comparable. It's rare for us to find a mid-market company that is beyond 1.5 times net EBITDA. Right? Which also ties in back to what you're saying, 55% debt to GDP. Right? That's the ground presence that we see. Is it good for us? Absolutely. Because we are fundamentally seeing a lower levered company, right? Is it good for the economy? Not at all, because it means that there is a lack of faith in either legal systems or regulatory systems or security creation systems, etc., that will allow you to lend with peace of mind, right? So many things have to go together: data, the regulatory architecture, recovery systems, security creation, right? And along with that, we will see an increased investor confidence, and we will see an increased ability to lever and use that to grow, right? So we absolutely see it as an opportunity. I think we are in a cycle that will not stop. There were, of course, triggers last year, which gave us an impetus as an industry. But I think we are now in a cycle that will not stop for many years.
Interesting. Sandeep, any thoughts on that?
Yeah. So I agree with Vineet, and I feel that the private credit space today is in a very nascent stage. I think we are where what perhaps private equity was maybe say 15 or 20 years back. So I think private credit is this just the beginning. I think we are just sort of having far more matured corporate houses, as rightly Vineet said, that they are far more transparent, they are far more regulated. There's the next generation which is now come in, which is sort of well educated, want more organized capital coming in. So I really see that there is a huge amount of opportunities, and that's perhaps the reason, as you rightly said, that there have been like almost 25, 30 new AIFs which have come in. I think the space is still large. Also, secondly, I clearly feel that there is enough space for all of us to exist, in the sense that right from banking, I don't think any one of us is a substitute to bank finance. I think we cannot be substitute to bank finance. Bank finance, NBFCs and AIFs, I think there is enough and more space available for all of us to exist and really grow the whole credit market.
And just perhaps a question to all three of you. I think mid-market, MSME, but are there any specific sectors which, according to you, are the least penetrated and may require a lot of credit deployment in the years to come?
So I think we've been talking about the CapEx cycle for a long time, right? Going by the last 12 months of evidence, I would say there is very real evidence that the CapEx cycle is starting. Now, the Indian corporate sector massively deleveraged and possibly did not do much by way of real asset creation from 2016. So it's like 7 to 8 years of hardly anything. Which means that there is a lot to be done. So whether we take steel, we take auto, we take infrastructure, we take healthcare, right? We take logistics, we take power sector, especially the renewable power sector, right? There is so much happening all around us that it's actually difficult to, to choose, right? Having said that, certainly infrastructure has been a huge area. For example, any single infrastructure project gets subcontracted, okay? The primary contractor is a AAA company. The subcontractor is a BBB company. The AAA guy can issue a 50-year bond. The BBB guy has to bring in equity, right? So that's the opportunity for someone like, let's say, an alternate investment fund manager to come in and bridge that gap and make that happen. Infrastructure is certainly something. Renewable energy, absolutely so. Logistics, absolutely so. Healthcare is expanding rapidly. These are outstanding opportunities today for anybody in the space.
No, I agree. I think I think Vineet has covered it well. I think that's right. We really say that, and he rightly said that infra itself is a large sector, and infra has a lot of subsectors. Infra could be right from from road projects to toll collections to oil and gas EPCs, every kind of other EPCs. You've got so many other kind of corporates which are today looking at this kind of capital. And if you see the last 2 years, equities have done very well, but they have given limited opportunities for, if you see on the infra and other related companies like those. So hence, this perhaps is one a large opportunity for them. Yeah.
Neeraj?
Yeah, so I too believe that infra is an asset class that actually is starved of this kind of capital. Predominantly, I would say there is an opportunity which I think across the spectrum of infra, including various sub-asset classes. One, I would say there's a lot of penetration that can come. And I would say, a little bit of a patient capital is also required. So it can be a mix of domestic and offshore capital that can chase this asset class. I think this can be a good, I would say, long-term yield-generating asset class that one can look at from this platform.
Interestingly, none of you mentioned real estate. Is there a reason behind that, or that's a completely different asset class?
No, I think real estate, I think per se has done very well. I think we clearly feel that last couple of years, there has perhaps been credit has got redefined as saying real estate and non-RE. So in that sense, if you see initially, most of the credit funds were real estate funds. It's only the credit for the pure corporate credit funds have only come very in recent times, maybe last 6, 7 years, 7, 8 years. So I think that's the distinguish, but I mean, we really have not really any bias towards RE. I think RE is very interesting. Yeah.
Moving to you, Neeraj, I think you, of course, have a large private wealth management business also. When it comes to fundraising, there is, of course, two broad pools of capital. There's domestic investors, there's offshore investors. There's, of course, been a spate of liquidity rise in the country over the last few years, particularly, with family offices, HNIs, individuals or families who've sold their businesses. They're sitting on very, very large amounts of liquidity. From a fundraising standpoint, has there been a change in trend? Is there more allocation which is coming to private credit as against what was coming, say, a few years back?
No, absolutely. So let me kind of take a step back and look at debt or credit as an asset class. There has been a tectonic shift in terms of how debt as an asset class used to look for wealth managers like us. Predominantly, debt was less of active management, more of, I would say, tax shelter that used to work. Now, with the change in the taxation regime, we see a lot of active managed kind of products coming in the overall bouquet of an investor who's looking at an allocation towards debt. And with the hurdle that an investor, typically a high net worth individual, has in mind, which he used to have earlier when the tax regime was used to be favorable, this asset class does deem, an allocation at least on the satellite portion of the debt allocation. Because typically, if you see, most investors look at debt as I would say, a peaceful portion of the capital that is not much of a high risk. Risk comes from equity. But within debt also, I would say, with the change in the taxation regime, there is an allocation that is going towards this asset class. Typically, at least to start with, on the satellite portion, the core still remains the very, very risk-averse kind of investments. But yeah, I would say going forward, at least the more professional or more nuanced clients like family offices have actually understood this asset class well. They are not only looking at investing, in this asset class through an AIF route, but they are also looking at co-investments, and opportunity lies there as well. So I feel that there has been a change, and I think this change is only going to continue. This is becoming an important source of capital. While there are challenges from the offshore, capital, I would say, investors that we are facing because of the returns that they're getting in their own home country, and net of tax and net of hedge, I would say returns are in the same range, if not more. This pool of capital is a serious pool of capital that is getting, I would say, serious about this asset class. So yeah, so there has been a change, and I would say this is going to continue for the near term as we speak.
Just taking a cue from that last point, Neeraj, let me pose a question to Sandeep, you and Vineet. Currency risk, at least for foreign capital, is becoming a significant concern because the rupee has been steadily declining against the dollar. Is there, of course, now we know hedging and all of those things, but one, is it realistic? Is there anything else which could be done? Is the Indian credit market or the opportunity sort of good enough, or the returns good enough to kind of tide over the currency fluctuations? Would love to hear your thoughts on those.
Yeah, so we have our pool of capital is both domestic and and offshore. I think domestic, rightly, as it has covered it well. So I think Neeraj has done that. But I think just to add to offshore, I think there are various kinds. I think it depends on LP to LP. This is a decision more at the LP level which they take. I think you can even now find a lot of large pension funds which have perpetual capital in the country. So they actually are okay to take that hedge call and say, fine, we are ready to take a call on the manager, we are ready to take a call on the strategy, and then invest in that particular fund. So I think that's one of the decisions which they take, and it's just not the hedge cost which they sort of look at. I think second is that we, for example, which is, say, a regular cash payout kind of, debt funds, the way we operate, is also a huge help, or sort of works very well for what a lot of larger offshore funds, because they clearly feel that this sort of works as an auto hedge for them, and the hedge cost reduces drastically for them in that phase. So I feel there are a couple of reasons. I think it's more at the LP level which they decide, but I feel there is serious offshore money which is there. I agree with what Neeraj said, is that there is a opportunity which is there overseas, but I think they clearly see India from a long-term perspective.
Interesting. Vineet, any thoughts on that?
Two things to add. One is that last year, actually, the rupee depreciation was 0.5%, right? So, and that's also because US rates were at their highest, right? And linked to this is essentially the expectation of the division between US rates and India rates. Nobody can predict the future, but at least for the forthcoming 12 months, it does not look like the divide is very high, which means that relatively low hedge cost of 2.5 to 3.5% is the next 12 months expectation, right? Now, all of us have seen 7% as well, and that can always happen at some point of time in life. But it looks like for some time, it is going to be relatively benign, which means that it is easier for someone like us, like the two of us, to actually raise dollar capital.
Just segueing into the next question, of course, rupee capital, because of the large amounts of liquidity, may be easier to come by. That's my perception, please correct me. Dollar capital takes time to come in, but of course, large institutions, etc., Sandeep, like you said, is more sticky capital. Once they repose faith in the manager, they would sort of stick with you for fund 2, 3, 4, and onwards. Is that right, wrong? Any sort of reactions, thoughts on that from all three of you?
So I agree. I think the domestic capital is the new sort of buzz which is there, which is all around. We've been doing it from our fund one, so we've been doing it for last almost a decade. We've been raising domestic capital and offshore capital. I think offshore capital, as you rightly said, I think more than stickiness and the ticket size, I think they also get a lot of a value chain in your investment. So they get a lot of sort of ESGs and sort of other, and other great good practices which they get along with them, I think, which really helps the in the industry and the fund to grow. So I think there's a lot of value add that global funds, when they come into your fund and they come and invest, they actually get a lot of these value add to you. I think there is enough space for both of them to be there for a long term.
I think one last point here, I think one should look at offshore capital as GPs versus LPs. I think GPs who have a long-term plan of investing in India are still okay to look at it as a very serious investment asset class, and they are doing it as we see. But LPs might have a short-lived, expectation, and that is something that we should be watchful or mindful of. But GPs are, I think, very, very positive, who have a very, very long-term plans of having a presence out here.
I think the difference is going to be between massive scale of that, let us say, one large offshore LP can give versus granularity and predictability of domestic, right? The last 2 years, we've had a fantastic experience where with every succeeding quarter, the predictability of the amount of money we could raise per week could be ascertained. Now, why does that help us? It significantly helps us in deploying capital, right? Because a fund manager like us does smaller value trades, more trades. It's important for me to say, okay, we have money to deploy, right? Versus, figuring out when the next large check will come. So I think granularity and predictability is becoming more a feature. This is something used to associate with mutual funds only, SIPs and the likes, right? But slowly, hopefully, we'll reach that point at which we can do it for credit AIFs as well.
I think one point which all three of you mentioned, that the biggest opportunity is on the mid-market MSME side, where most of these companies, if not all, maybe set up in tier 2, tier 3 cities, and the real growth in India is happening in those cities. And maybe a question for all three of you, like, do you feel that's a challenge while the entire financial services sector, at least in India, has traditionally been in Mumbai, which has expanded to, say, Gurgaon, Bangalore, and maybe a little bit in Hyderabad, Pune, etc. But when we talk about tier 2, tier 3 cities across Rajasthan, Uttar Pradesh, Gujarat, etc., is that a challenge? Is that an opportunity? How do all of you see it?
So I really don't see it as a challenge. I think it's a brilliant opportunity, and I think there is an amazing amount of development that's happened across tier 3, tier 4 cities. We've done some basic numbers. We see there are more than 4,000 mid-market corporates which are at top line anywhere between, say, 600, 700 crores to, say, 4,500 crores. And we clearly see that there is outstanding opportunity in these. These are very well-run technocrat companies, now have good sort of transparent practices which they have built. The promoters, next generation has come in. He comes from the whole private unsecured financing market is reducing. We actually see some of those getting converted into our LPs, in fact, on the domestic side. And they clearly feel that they all want organized capital to come in, which is seeing. I think a lot of these people don't want to dilute. They clearly feel that growth capital coming through and through a credit fund gives a large amount of, so I absolutely feel that there is outstanding amount of opportunity, not just tier 2, tier 3, I would actually go lower than that also, including tier 4 cities. And I think the whole network which has happened on the whole, the whole Udan and the whole connectivity across Pan India has hugely helped for people to actually stay in smaller cities and yet look at larger base of capital.
Just reading a report, the entire road network in India in the last 10 to 12 years has more than doubled. The number of airports have almost tripled. So
that's true.
Neeraj, any thoughts?
Yeah, so I think I do agree with Sandeep. This is a huge opportunity for domestic managers who have their ears onto the ground in terms of understanding what is going on around and then kind of creating a product around the actual customized need of such corporates which are there. And I think that's going to be a huge opportunity going forward as well as we grow to that 5 trillion mark that we have in mind. I think that's a huge opportunity.
Any expansion plans, Vineet, across the country in different cities?
Well, we have 10 satellite offices already as a result of exactly what Sandeep outlined. And it's quite likely that we'll have more before the next year is through, right? Because I think it's absolutely important for us to be deeply local in a business model like this. Otherwise, we'll end up missing opportunities and missing good companies. It's important to note that for a company that's, say, unrated BBB single A, they don't really care about bonds. For them, they need money. So it's a loan substitute, right? So it's not just about finding the company, it's also about educating them about what it takes to participate in capital markets. There's a significant amount of work to be done to take companies up the curve to make that happen. The last point is that you're right that we need to be locally present and go deep, but the digital information highway is absolutely centralized. And that is today a phenomenal way for us not just to narrow down to the 4,000 that Sandeep outlined. I think we're all after the same 4,000. But also to understand them much better, monitor them much better, much more real time, and much more independent of the company's auditor.
I think from a growth standpoint, while on the business side, the numbers are showing everything is going good. But I think as an asset class and for the asset class to grow, we also need the support of the regulators. While the regulators may or may not have been playing ball, at least on credit as an asset class, because while for the performing credit alternatives industry, it may be good because of RBI's tightening on norms, etc. But on the SEBI side, Vineet, my first question is for you. I think we all went through the cycle of senior subordinate structures. There were some perceptual issues which the regulators had for a very specific reason. But there's obviously a much wider requirement for this, for just overseeing the growth of credit as an asset class. Any thoughts on that? Anything which you would expect from SEBI or from the regulators on this?
So I think as the regulatory architecture is developing, there are many positive signs and some signs that the architecture will mature over time. Positive signs, for example, is dematerialization. Positive signs is accreditation, right? There are positive sciences around making sure that there is mandatory custody of assets, right? So some of this might add to cost, but in the long term, these are all going to be positive areas in building AIF as an asset class, right? Areas where we lack maturity and we need to work some off, right? Okay, today you have listed REITs and listed InvITs. You don't have listed AIFs. Transferability is difficult even today. DMAT may help, right? Blended finance is a very, very critical part of the AIF industry globally. In India, we are yet to find our balance, right? So as it is with any young industry, regulatory maturity will take its own time to develop as the regulator gains experience, right? And in the meantime, if there are malpractices, then that causes a shock, that causes a reaction. But at the end of the day, I think we'll move on because the result is going to be positive for the entire industry.
Thank you. Sandeep, the next question is for you now. RBI and SEBI, of course, have been concerned with evergreening and some of these aspects. And RBI came out with a circular very recently, which kind of requested banks to provision their investments in the AIF if the same financial institutions had also invested or given loans to underlying portfolio companies. Now, the intended consequences were evergreening and to check that, but the actual consequences had much wider ramifications. Any thoughts on that?
So, I think overall, Devas, I feel, regulators have done an outstanding job. I think right from, say, a CIBIL to, the transparency that they have gotten in the system, and which is one of these guidelines is part of that transparency that they want to get. I think, I actually feel that some of this was there just around the corner. It's come. It was there for actuality, and the whole IBC as the way it's been working, I think it's been changing and it's been changing for the good. So I think I overall support some of the stuff which is happening at the regulator level. I feel they have, with the kind of, the number of industries that we have, the kind of population that we have, I think it takes time. It's young, but I think it's changing for the good. I think they're getting more and more transparency on the system. I think it's very well done.
I think perhaps, Neeraj, for you, do you feel that regulators should be more consultative with the industry before they come up with reforms or changes?
I think maybe let me talk about what has been done. I would say from an investor's perspective, because we also need a lot of capital to be, deployed in this asset class. I think the tighter regulation actually helps from an investor's perspective because, then you're looking at an industry which is overseen by a regulator and you have no trust issues. At the end of the day, the asset management industry is all about trust and governance. And if you can actually instill that through the actions that the regulator is taking, the long-term, I would say, the impact is only positive. And it should be looked at from very long-term perspective, not a short-term blip or, cause. I think this is really good that is happening because investors feel more confident when it comes to investing in this particular asset class.
And if each of you had one request from the regulators, be it SEBI or RBI, for credit as an asset class, what could that be?
I think we can go a very long way on accreditation. I think this has done extremely well in international markets. And if there are very, very clear incentives provided to probably everybody in this room to get themselves accredited, and in terms of the complexity of investments that they can access versus not, and there's a very clear framework placed around it. I think once we do that, the regulatory structure of complex products, be it an AIF or a PMS or a REIT or an InvIT or something, can be clarified and simplified if we know who is putting in the money. So I think accreditation would be my single biggest task.
No, I actually feel that the regulator has both intelligence and artificial intelligence to substance. So I think they really, they know, they exactly know, and they do come to us for various suggestions and, at times with papers. I think they are getting where, I think it's just that it takes time. I think the industry is going a little faster. So I think that's the reason why we do feel some of these things, but I think they're doing a good job.
I do agree because regulator is always ahead of, I think, what we can think of. And I don't see a reason why we should not appreciate all this. But maybe a small, ask maybe in this asset class, typically if you see globally, your pension funds and institutional capital has always taken the lead when it comes to, these, asset classes. In India, that has not been the case. It's been always the domestic individual investors who actually been the first ones to take a plunge. I would say if something can be done towards getting that money also shift into this asset class, I think that will be a very, very good step ahead.
Last 5 years have been phenomenal for us, so no complaints.
Are there any regulators in the room? All the panelists are being very polite.
No, I'm being honest.
I think just one last question. I mean, again, some empirical data around this. India has had the lowest recovery rates amongst its Asian peers. While IBC came into whatever shape and form, it started off about 8 years back. It's been 8 years since IBC has come in. Various cases have been resolved and several cases are on the way of getting resolved. And this is a question to all three of you. Do you feel personally that our IBC is a real tool which could effectively sort of address insolvencies and any kind of delinquencies? Or right now it's acting more as a deterrent and it still has a long way to go?
I feel absolutely. I feel IBC has been one single or one big act that has come in the last decade, in the legal system. I think it's been phenomenally good. There is actually a fear, or there is actually a fear that a promoter might lose his company. There's in reality where a financial creditor is actually running the entire process. So I think this is happening for the first time. Of course, there are changes which is being happening to it. There are suggestions which go in, and there are changes which is being done. I think it's a very good act.
To put it simply, I think it's taken 7 years for 7 years post IBC for 40 credit funds to come up, right? So naturally, a lot of jurisprudence, a lot of precedents, a lot of case law, a lot of experience had to come in. And also, the way IBC is structured, very simplistically, is that there is a market value for the assets, and therefore there can be somebody who steps in and takes over, and therefore manages servicing of liability, right? And the committee of creditors decides how the process is run, and can there be a market for it, right? Now, the market also takes time to develop. The market was good for very high quality, large assets. Slowly, you see this coming down to mid-market, right? As a market for stressed assets starts developing, right? And that's when IBC becomes really powerful. So one part of it is the jurisprudence and the experience of case law, but the other part also is the marketability and buyers being available, alternate buyers who can run the assets. That's now become much better in the last 12 months versus the last 8 years.
Neeraj, any final thoughts on this?
No, I think IBC is a mammoth step. I believe that has actually instilled a fear of God in the promoters that you can actually lose control. But yeah, lots can be done there. But I would say a lot of risk management today. I'm sure that Sandeep and Vineet will talk about it in more detail. But I think a lot of risk management is now based on the fact that IBC can be a tool. But yeah, it might take its own time. But we are very, very positive about this, that any law or any act, when it comes, it typically takes some time to kind of be practically, I would say, deployed. This is going through its own time, but I think this is the way forward. If this can be cracked, I would say this asset class can be a big, big beneficiary.
Thank you. And I can see Aditya making several hand gestures at me, so I'll take that as a cue. I would like to thank all my co-panelists, heartfelt gratitude. Thank you so much for sharing your thoughts on the panel today. And would like to open it up for any questions which you may have for any of my esteemed co-panelists. So happy to take those up right now.
Do we have any questions?
Rahul, your question was whether for the panelists is IBC the primary mode of recovery, or are there any other alternatives which you're using?
I run a real estate fund, so for us it's IBC, and not that happy with the time that IBC takes. So
primary mode of recovery is to get it back from the borrower, yeah. But on the legal system, yes, IBC is one of the things. You of course can go to the courts. I mean, you still can go to civil as well as criminal courts. Surface is, of course, available only to listed bonds, not to the unlisted bonds. So that's still a limitation to a lot of the unlisted bond which happens on AIFs. But yeah, IBC is one major way where you can go and do it. We actually are more on the larger tickets. We don't really use too much of that these days.
Maybe one point on the IBC that you mentioned. I think pre-IBC is something that we have seen, a lot of resolutions happen out just before the admission is done. I think that has been more successful for at least us when it comes to the law. But yeah, I think because of the backlog of certain COVID timeline, IBC is taking a little more time than usual. But I think once this gets cleared, it will be a very, very fast tool to recovery.
So Rahul, just one small point on that. So 138 used to be very, very prominent, but even as lawyers, we've stopped advising clients because Supreme Court came out with the judgment saying 138 cannot act as a deterrent or for loan recovery. I mean, it could be in the regular course of things that you've gotten a check and you did not honor it. But because of this particular reason, we are not seeing 138 being utilized very extensively, at least for recoveries. Any last questions before we wind up?
No questions? I think we are good to go. Thank you. A huge round of applause for all the panelists. And I request you all to please stay back. I would like to call upon stage Ms. Madhulika Sanghvi to felicitate the panelists. A round of applause for Ms. Madhulika Sanghvi. Friends, there are no questions, no claps. Can we have a huge round of applause? Thank you. Can we have a photo op? I request all the panelists to come ahead for a group picture. Thank you so much. You all may please take your seats.